Too often, business owners feel like taxes and tax season is something that happens to them, not for them, and that's unfortunate. Today, we will be looking at how you can take control of your taxes starting with a self-assessment process. We'll then move forward through tax season using some helpful tools, and then we'll take a look at how you can use the remainder of the year to take control of your taxes. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. Today's conversation is one that all business owners can benefit from. Your taxes are a significant financial component of your business. You need to have a sense of control when it comes to planning to file, the actual filing process itself, and then the steps you take throughout the year to take control. We are going to start with a quick mention of when you should review your previous year's taxes, why and how you assess a previous year, additional tools to help during tax season, and then what you do throughout the remainder of the year so that tax season doesn't come as a surprise. There are 3 critical times for reviewing taxes throughout the year, each offering unique opportunities for proactive tax management. The first crucial period occurs before preparing to file returns, typically early in the year. This initial review allows individuals to assess their financial records, identify potential deductions, and ensure accurate reporting before filing their tax returns. The second opportune time is during the summer months between June and August. During this period, individuals can evaluate any changes in their financial situation, such as income fluctuations or new investments, and explore tax-saving opportunities before year-end. Lastly, before the end of the year, usually in November or December, presents another essential window for tax review. This final assessment enables individuals to conduct a comprehensive review of their year-to-date income, deductions, and tax liability, allowing them to implement any necessary tax-saving strategies before the close of the tax year. First, we have opportunity number 1. What do we do before we prepare our actual taxes? Conduct this review in the first few months of the year, typically January or February. During this time, individuals should review their previous year's tax returns to identify any missed deductions, credits, or errors that may have occurred last year. You're going to use the assessment tool I'll share shortly to do so. Additionally, it's essential to assess your current financial situation, taking into account any major life changes such as marriage, the birth of a child, or starting a new job. By conducting this review early in the year, individuals can ensure accurate reporting, maximize potential tax savings, and address any significant changes in their financial circumstances promptly. When reviewing your previous year's tax returns, there are several questions you can ask yourself. Are all my income sources accurately reported on the tax return? Did I fully maximize deductions and credits applicable to my situation? Were there any overlooked expenses or eligible deductions that could have reduced my taxable income? Did I take advantage of all available tax-saving opportunities, such as contributions to retirement accounts or education expenses? Are there any changes in my financial situation or tax laws that could impact my tax planning for the current year? Asking these questions is crucial because it allows individuals to thoroughly evaluate their past tax returns and identify opportunities for improvement in their filing strategies. By ensuring all income sources are accurately reported and maximizing deductions and credits applicable to their situation, individuals can potentially reduce their taxable income and overall tax liability. Overlooked expenses or eligible deductions could result in missed opportunities to lower taxes owed or increase tax refunds. Additionally, taking advantage of available tax-saving opportunities, such as contributing to retirement accounts or education expenses, can further optimize tax outcomes. Regularly reviewing past tax returns also helps individuals stay proactive in adapting to changes in their financial situation or tax laws, ensuring they are well prepared for future tax planning. Apply any lessons learned as you prepare to file this year's tax returns. Why should you assess your taxes? Assessing past taxes is essential for financial health and future planning. It allows for the identification of missed opportunities, errors, and areas for improvement. In addition, optimizing tax strategies based on past assessments can lead to minimized liabilities and maximize savings, while past tax assessments provide valuable insights into financial trends and patterns, enabling informed decision-making. Now let's look at an app that will help you with the self-assessment process. There is a tool that you will use to assess your previous year's taxes. It's called the Confidence in Quality Tax Rubric app. Once you've used that app, you are then going to think about the preparation process. Earlier in this series of webinars, we discussed preparing for your taxes, and I'd like to take a moment to make a deeper dive into the tax prep because it naturally follows the assessment process. We're going to use the Homegrowns Preparing for Tax Season, a guide for home child care providers. The title is a bit of a misnomer. There are many areas of that guide that can apply to small to mid-sized centers. Once you've used the Homegrown Guide, you would advance to the tool known as the TurboTax Self-Employed Online Tax Preparation Guide for Child Care Businesses. It was originally created to walk providers through TurboTax and then evolved into a tool that expands on the actual tax filing process. Even if you don't use tax software like TurboTax or you have someone else prepare your taxes, I can't suggest strongly enough taking a look at the TurboTax tool. Let's start with the Confidence in Quality Tax Rubric app. This app was developed to allow childcare business owners to evaluate their own federal tax returns for consistency with best practices for their program type. The app can be accessed on your mobile device, desktop, or laptop computer. Here you can see what the starting screen looks like. Please know that the app was developed with the generous support from the Wisconsin Early Childhood Association, or WECA, through the Wisconsin Department of Children and Families. Using the app will provide childcare businesses with a personalized review of their potential tax risks and opportunities summarized in a downloadable report that is easy for both you and your tax preparer to understand. Now, how do you get started? There are only two things you need in order to begin. Last year's Schedule C of your Form 1040 from your latest completed tax return, and about 15 minutes of your time. If you are a center, we suggest following along looking for opportunities that may exist from the self-assessment of last year's taxes. Just in case you aren't familiar with what a 1040 Schedule C is, let's take a look here at the image on the right to see what the Form 1040 Schedule C looks like. Once you have that, you're ready to continue. Now that you have your Schedule C, you're ready to begin. The first step is to access the app. The app can be accessed by entering the link seen on your screen into your laptop, desktop, phone, or tablet browser search bar. Once you're there, it will ask you to accept the user agreement and confirm your type of business before taking you through a series of questions based on your tax form. From here, the rest of the process can be completed in 4 simple steps. First step is to visit the app. You will see the QR code for the app on your screen, and the link has been entered in the chat. Please note that this online tool does not retain or share any of the data you enter. All information provided is used for evaluation purposes only and deleted upon completion of the process. The app is available in both English and Spanish. The 2 QR codes are for each language. Once you've begun, you will tell the app whether you are a home-based provider or a center. You enter your email address, and then you will proceed through the site's prompts by answering a series of yes or no questions. Answers to each question are dependent on if you have information entered in the relevant line. Here's an example question. These questions on the screen pertain to entering gross receipts, and then moves on to repairs and maintenance. After you've completed the questions about your tax returns, all that's left to do is answer some final general questions to check for common errors. Then, insert your email address in the provided submission box. And that's it. You're done. If you have not received your report after 15 minutes, be sure to look in your spam folder. As a reminder, this online tool does not retain or share any of your data or results. All information provided is used for evaluation purposes only and is deleted upon completion of the process. Your email address will only be used to send you a copy of your personalized report. Now, once you've moved through the assessment, take the time to read the report. Think about areas for opportunity and strategize, and then move on to the Homegrown Guide. This workbook from the organization Homegrown aims to help home-based child care providers optimize their tax preparation process and maximize deductions. It covers key topics like record-keeping best practices to implement now, such as tracking income, expenses, mileage, and business usage of your home. Understanding Schedule C and where to capture income and different types of business expenses. How the business use of home deduction works, including calculating and documenting the time-space percentage. Maximizing write-offs with eligible deductions for supplies, meals, utilities, repairs, insurance, and more. Tracking and claiming automobile mileage for business travel. Depreciating assets like equipment and furnishings over time. Taking advantage of the qualified business income 20% pass-through deduction. Choosing the right business structure, such as an LLC vs. a sole proprietorship. Proactive tax planning steps to take this year to maximize next year's return. The workbook includes checklists, guides, and visual examples that walk through every step to support home-based child care providers in preparing for tax season by providing actionable steps business owners can implement now to make tax time easier and save money. We work with Homegrown to update their tax preparation workbook annually, available in English and Spanish. The first section of your taxes is all about revenue, that is, how much money you made. Getting this information may be easy if you have an accounting system. If not, no worries. You can use the revenue worksheet below to calculate it. Start by gathering your records. You are likely to have 3 types of records for revenue. 1.1099 forms. These are evidence that another business paid you for services. Many home-based child care businesses will receive a 1099 NEC for the subsidy care payments and for participation in the Child and Adult Care Food Program, or the CSCFP. You will want to check IRS rules surrounding the issuing of 1099s from payment apps such as Zelle or Venmo, as the rules surrounding these apps are expected to change between 2023 and 2025. 2. Bank records, showing additional funds you may have received from other sources. 3. Your own documents, such as year-end or weekly receipts that show parents paid for care. Then fill out a revenue worksheet. This sample is from the Homegrown workbook. Include each 1099 and revenue for each child you serve. Also list other income, such as grants, that may not already be accounted for on a 1099. If you received reimbursement for food costs through the Child and Adult Care Food Program, you can report all the reimbursements under the Income section of Part I of the Schedule C using the 1099 you received. You can then deduct your food expenses in full in the Expense section. Now that you have your business income, you will need to collect your expenses. This will be what you spent money on for your business the previous year. Make sure you have records of your costs, ideally receipts showing payment for expenses. But you can also, in most cases, use canceled checks, invoices, or credit card and bank records. It is critical that any proof of an expense show that you paid the expense, the amount you paid, the date you paid it, a description of the item purchased or service received. To collect your expenses, you will want to start by collecting all your receipts. Next, go month by month in your records for the previous year to review your credit card bills. Check app-based system payments, such as Venmo, Zelle, PayPal, and Square Cash. A look at your bank statements and checks. With your accumulated expenses, you can now fill out the digital expense worksheet included in the guide on page 10 and on one of the Google Sheets tabs. The worksheet uses the expense categories for the Schedule C that are most relevant to home-based childcare businesses, but they can also be used for any corporate or partnership tax return as well. The full amount of home expenses that are directly related to your business can be included in your expenses in the table above. The IRS defines a direct expense as one that is incurred exclusively for the business and provides no personal benefit. Some examples of direct expenses in your home are fixing a bathroom used only by the children, getting a new children's rug for the play area, and playground equipment. Indirect costs associated with your home, such as homeowners insurance or your electric costs, will be covered in the following section, which covers your business use of home. You should keep all pay stubs during tax season and at least 4 years afterward. It's great to have paper and electronic copies, even if that's just taking a picture of each with your phone. Here on your screen, you are going to see the next tax tool that we have, which is the TurboTax Self-Employed Online Tax Preparation Guide. There is some overlap to the content in the Homegrown Guide, but I am still going to suggest that everyone review it. It is available in both English and Spanish. Once you've moved through these tools, think about if you are going to use a paid preparer or prepare your taxes yourself. Now that we've made it through the initial assessment as last year's taxes, you've taken into consideration everything for the current tax season and filed your taxes. What is the rest of the year going to look like? This is our second opportunity now that we've addressed the filing for the previous year. The mid-year tax review. Conduct this review in the middle of the year, typically between August and October. During this time, individuals should review their current year's tax situation based on income, expenses, and investments. It's essential to evaluate any changes in financial circumstances or tax laws that may affect your tax planning strategies for the year. By conducting this review midway through the year, you can proactively identify opportunities to optimize your tax outcomes and make any necessary adjustments before year-end. Our first thing to consider for a new tax year: consider events like marriage, divorce, birth or adoption of a child, buying or selling a home, or starting a new job, as they can have tax implications that may require adjustments to your tax planning. Then, have there been any significant changes in your income compared to last year? Assess any increases or decreases in income sources, such as salary, investments, or side businesses, to understand how they may impact your tax situation. Next, consider deductions. Are you maximizing deductions and credits available to you? Review potential deductions and credits applicable to your situation, such as education expenses, medical expenses, charitable contributions, and retirement contributions, to ensure you're taking full advantage of available tax benefits. Don't forget tax law changes. Are there any changes in tax laws or regulations that could impact your tax strategy? Stay informed about any recent changes in tax laws or regulations that may affect your tax planning for the year. Consider consulting with a tax professional or researching updates to ensure you're in compliance and can take advantage of any new opportunities. What do your records look like? Have you been keeping accurate records of your expenses and receipts throughout the year? Ensure you have organized records of your expenses and receipts, including documentation for deductions and credits you plan to claim on your tax return. Keeping thorough records can help support your tax claims and minimize the risk of errors or audits. And finally, a very important component of the mid-year tax review: estimating that fourth quarter estimated tax payment. There are two methods: profit-driven and income-driven. Of the two options, doing your review just based on profit is the fastest, but it is also less accurate than basing it on your family income. You can likely run through this option in about 15 to 20 minutes. Step 1. Determine your profit. Subtract your total expenses from your total revenue. Remember, this should include your actual and estimated amounts through the end of the year. The resulting number is your profit. For example, if Tanya's information showed $105,000 in revenue and $67,000 in expenses, her profit would be $38,000. $105,000 revenue, $67,000 expenses equals $38,000 profit. Step 2. Determine your estimated tax. When sole proprietors have a profit, they are required to pay both self-employment tax and then income tax. If you are an S corporation owner or an LLC that is treated as an S corporation, your W-2 income is an expense, so your profit is taxed as regular income. That is, there's no self-employment tax. A good estimate for how much of your profit will be taxed is using a rate of 20% if you don't have a state income tax, or 25% if you do. Consider the following example. Tanya had $38,000 in profit, and she lives in a state without income tax. In her case, she would want to estimate her profit using a rate of 20%. $38,000 profit. X.20 estimated tax rate equals $7,600 estimated taxes. Using this rate, Tanya can assume $7,600 in estimated taxes by the end of the year. Next, Tanya can compare this amount against what she has already paid. Tanya had checked with the IRS site when she collected her data and saw that she had paid $6,000 in estimated taxes earlier in the year. $7,600 total estimated taxes. $6,000 taxes paid to date equals $1,600 estimated taxes remaining. Based on this information, Tanya should pay another $1,600 before December 31. In this case, Tanya had a positive number for her profit. But let's say she didn't and found that she will lose money by the end of the year. In this case, Tanya's estimated tax would be zero. She will also want to look closely at her revenue and expenses to see if there was any way to cut costs or boost revenue. Step 3. Mitigate taxes. Before you write a check for additional estimated taxes, you will want to think about strategies for mitigating your taxes. We are going to suggest more tax mitigation strategies a little later in this presentation. As you use some of those strategies, you could then adjust your numbers to better know what you should pay before the end of the year. But let's think about how Tanya could mitigate her taxes by, as an example, putting some of her profit into a SEP IRA, Simplified Employee Pension, which is a business retirement account where you can deduct the cost from your business expenses. Keep in mind that this is not a webinar on retirement strategies. Let's say she decided to put $5,000 of her profit into a SEP IRA. Tanya's revenue is still estimated to be $105,000, but her expenses have now gone up to $72,000, the original $67,000 plus the additional $5,000 for her SEP IRA. $105,000. Revenue, $72,000. Expenses equals $33,000. Profit. Since her profit is less, her estimated taxes will be less too. $33,000. Profit, X.20. Estimated tax rate equals $6,600. Estimated taxes. Since she had already paid $6,000 in estimated taxes in this scenario, Tanya now only needs to pay $600 more now by the end of the year. Now, let's say Tanya wants a more accurate number of her estimated tax bill. In this case, she can use a family income-driven approach. Though she will need some more data to use this method, she will also end up with a more precise number for her taxes based on household income and deductions. Income-driven tends to be more accurate. Step 1. Gather additional data. In addition to the information you already collected, to use this approach, you will also want to have any W-2 income information for you and or your spouse, specifically your total annual pay and how much withholding has been taken out. You can do this by looking at your latest paycheck to see the year-to-date amounts. If you divide them by the number of months to date to get an average monthly amount, and then multiplying that by 12 months to get an annual amount. Tanya's spouse's paycheck showed through the end of June she had earned $54,000 and had $12,000 in withheld taxes. In this case, we divide both numbers by 6, since it is the end of June, to get a monthly average of $9,000 for wages and $2,000 for withholding. We can then multiply the monthly averages by 12 to get an annual average. Monthly wages, $54,000, wages through June, divided by 6 months equals $9,000 of wages per month. Monthly withheld taxes, $12,000, taxes through June, divided by 6 months equals $2,000 of withholding per month. Annual wages, $9,000 x 12 months equals $108,000. Annual withheld taxes, $2,000 x 12 months equals $24,000. Additionally, you'll want to have information on your children's ages and educational status, your mortgage interest for the year, and your property taxes. And at the end of the year, we have tax opportunity #3. Conducting a self-assessment before the end of the year allows individuals to engage in proactive tax planning. Areas to assess include year-to-date income and potential deductions. Strategies include maximizing contributions to tax-advantaged accounts and harvesting tax losses to minimize tax liability. Review your year-to-date income to understand your current tax situation. Identify any additional income sources, such as bonuses or investment gains, that may affect your tax liability. Evaluate potential deductions available to you, such as contributions to retirement accounts, like traditional IRA, 401ks, mortgage interest, charitable donations, and eligible business expenses. Ensure you have documentation to support these deductions. Consider maximizing contributions to tax-advantaged retirement accounts before the end of the year. Contributions to accounts like traditional IRA or 401ks can lower your taxable income for the year, reducing your overall tax liability. Be mindful of contribution limits and deadlines for each account type. If you're self-employed or have significant income not subject to withholding, review your estimated tax payments. Ensure that your estimated tax payments align with your expected tax liability to avoid underpayment penalties. Explore other tax-saving strategies that may apply to your situation, such as deferring income to the following year, accelerating deductible expenses, or utilizing tax credits for education expenses or energy-efficient home improvements. By the end of the year, be sure to consider, did you maximize contributions to tax-advantaged accounts? Evaluate whether you've contributed the maximum allowable amounts to tax-advantaged accounts, such as IRA, 401ks, or HSA to optimize tax savings and retirement planning. Explore opportunities to reduce your tax liability by implementing last-minute tax-saving strategies, such as making charitable contributions, accelerating deductible expenses, or harvesting tax losses from investments. Ensure that your estimated tax payments or withholding throughout the year align with your actual tax liability to avoid underpayment penalties or overpayment of taxes. A good January habit is setting reminders in your calendar for the activities you need to conduct. Throughout the year, mid-year and year-end reviews. Starting in January, begin the process of SMART record keeping for that tax year to ensure easier review of data throughout the year. Make notes for yourself throughout the year of changing circumstances that you'll want to address next tax season. Thank you. For more information, visit the LISC Phoenix website at www.lisc.org/Phoenix or contact them via email at aezchildcarelisc.org or phone at 602-252-6315. You can also find additional resources on the Civitas Strategies website. And be sure to visit the Civitas Strategies YouTube channel for more valuable resources to support you and your business.